Trading and investing are two different approaches to the stock market, and which is better depends largely on your time commitment and tolerance for risk. Trading is about timing market moves and buying and selling stocks within a short period for quick profits. Investing, on the other hand, is buying an asset you expect will rise in value over time with the goal of long term gains. You must have surely heard about people making money from the stock market. Although there are a million ways to do so, we have two broad classifications of stock market activities: trading, who believe in reading charts, and investing, who believe in fundamentals of valuation over a long term period. Before we get into the specifics of trading and investing, let's understand the difference by looking at the two most influential and identical people in the world of wealth creation. One is known for his long term investments, and the other one is renowned trader. If you are a follower of the stock market, you might have already guessed the names. They are Warren Buffett and George Soros. Both have made huge piles of money over their lifetime in the stock market, but differently. Warren Buffett is worth about US 67 billion, who made his money of long-term investments in companies whose stocks he has held for decades. Let's look at one of his famous quotes. I will tell you how to become rich. Close the doors, be fearful when others are greedy. Be greedy when others are fearful. Conversely, there is George Soros, whose net worth is about US 24.2 billion, who has made money from a countless number of trades. One of his famous quotes is, markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. Trading involves buying and selling stocks or other securities in a short period of time with the goal of making quick profits. While investors typically measure their time horizon in years, traders think in terms of weeks, days, or even minutes. Two of the most common forms of trading are day trading and swing trading. Day traders buy and sell a security within the same trading day. Positions are never held overnight. Swing traders, on the other hand, buy assets that they expect will rise in value over a matter of days or weeks. In the world of trading, a stock's fundamentals are fairly irrelevant. Even if a stock's value is expected to go up over the long term, that doesn't necessarily mean it will do so over the next few minutes or even days. That's why traders tend to rely more heavily on technical analysis of market movements and news reports to inform their trade decisions. Trading can be a risky enterprise. If a trade goes against you, you can lose a lot of money in short period of time. And traders often increase their risk by using leverage. Leverage is borrowing money or buying assets with money they don't yet have. Options trading on margin or short selling are all ways of leveraging. Friends, I made a separate video based on leverage, so you can find the link in my description, so you can visit that link and you can watch that video if you want to have a complete view on leverage. Investing involves putting money into a financial asset, stocks, bonds, mutual or exchange traded fund, etc., that you expect will rise in value over time. Investors generally have a long time horizon and predominantly look to build wealth through gradual appreciation and compound interest rather than short term gains. The shorter the time horizon, the higher the risk that you could lose money on an investment. That's why the Securities and Exchange Commission Office of Investor Education and Advocacy recommends putting money in a saving account if you'll need to access it within 3 years. For all other goals, investing could yield much better returns. Some investors may even plan to hold onto their investment for multiple decades. Diversification means weighing a mix of investments is important for investors as it can reduce their risks, mainly by mitigating the effects of volatility, means rapid, violent, or unexpected changes in values or price. Today, investors can achieve instant diversification through mutual funds and ETFs, single investment vehicles that hold a variety of or a large number of assets. It's also important to consider your risk tolerance and estimated withdrawal date when selecting your portfolio's asset allocation. If investors do choose individual stocks or bonds, they will typically look at fundamental indicators, that is, elements intrinsic to the issuing company like its earnings, history, or creditworthiness. These factors help locate stocks that are undervalued. So, the key differences between trading and investing are: trading is done generally by the people who do intraday trading and are always looking for growth investment where technical analysis tools are used. They predict the higher or lower movement, while an investor, on the other hand, is looking for value investment and they stick with their investment for a very long time. Risk is very high in trading strategies since there is no hedge against this type of transaction, so money at stake is very high without downside protection. On the other hand, an investor might have a properly balanced portfolio where a downside of a particular asset will be the upside of the others of to hedge for the losses. The movement in the market and the indexes is generally due to large volumes of trading activity. So in this scenario, traders play a major role in moving the market prices as compared to an investor. Traders have their perception of upside or downside. They trade accordingly. They have different types of trading strategies like butterfly, short sell, long straddle, strangle, and many more. While an investor has a simple and vanilla strategy to hold the asset while investing. Returns are pretty uncertain and fast in trading since the transactions of buying selling happen daily. An investor has to wait pretty long to get handsome returns. A crucial everyday piece of information and quarterly results matter to the traders since these kinds of things bring a lot of movement to the stocks, allowing an opportunity for the traders. At the same time, an investor believes in the value and principles of the company. Although they both involve the financial markets and assets, trading and investing are really two different activities with different aims. So, comparisons and generalizations are tricky. Overall, though, trading is riskier for two reasons. It involves a lot of speculation, that is, quick decisions, educated guesses, and just plain gambles. It depends minimal or no diversification since it's difficult to monitor more than a few trades at the same time. Also, diversification by its even out nature mitigates both the ups and the downs, and traders want the maximum height they can get. However, it should be noted that trading can also mean higher returns. Investors may hope to earn 8% to 10% on their portfolio per year, but a trader may hope to earn that much or more per month. Even traders who earn just 5% per month would end up with an uncompounded annual return of 60%. For these reasons, it's difficult to crown either strategy as the best way to approach the stock market. If you have a low risk tolerance and want to avoid volatility, investing will be the one to go. But if you're more of a risk taker and would like the chance to earn big returns fast, so trading could be appealing.